Today, we're digging into a really interesting take from Capital Mind about why gold's recent moves are anything but random. They're making the case that a single policy announcement could force gold to reprice, and not over weeks or days, but literally overnight. So, let's get into it. Right, that's the big question, isn't it? How does a massive global asset like gold just shift so dramatically in a handful of hours? Well, the idea here is that the answer has less to do with the usual market stuff and a whole lot more to do with politics and, more importantly, the expectation of what's coming next.
If you've been watching the markets, you've definitely seen gold and silver bouncing all over the place. And it's really easy to just say, oh, that's just profit taking, traders cashing out their wins. But the argument we're looking at today says no, no, no. There's something much bigger going on right under the surface.
And that's the key. There's this quiet, underlying current that a lot of traders are completely missing. While most people are busy reacting to the daily headlines, some are already getting in position for something that hasn't even happened yet. A big shift is happening, and it's happening quietly. Okay, so this brings us to our first major point. We've got to understand how a political statement can trigger an immediate, and I mean immediate, market reaction. It's all about what our source material calls a volatility trigger. So the thinking goes that Donald Trump fits this description perfectly. It's not actually about the specific words in a speech. It's about what those words imply for the economy down the road. The market doesn't wait for a law to be signed. It reacts to the idea of the law way ahead of time. And these are the big ones to watch out for. Whenever the conversation pivots to trade, tariffs, China, or the Federal Reserve, gold does more than just listen. It reacts. It starts trying to figure out the ripple effects, what all this means for things like inflation, debt, and the value of the US dollar. And this quote really gets to the heart of it. The so-called smart money, they don't trade the news after it happens. They trade the expectation of what's going to happen. By the time you see an official announcement, the big money has often already made its move. They're setting themselves up for the world that will exist after the policy is in place. So, how does this actually play out in the real world? This leads us to what Capital Mind calls the policy domino effect. It's a super clear, logical chain of events that connects one policy idea straight to the price of gold. Okay, let's walk through this, because this is the whole engine of the argument. It all starts with the idea of higher tariffs. That can push up inflation. Now, to keep the economy from slowing down too much with higher inflation, there'd be a ton of pressure on the Federal Reserve to cut interest rates. And rate cuts, well, they tend to make the dollar weaker. And a weaker dollar has almost always been great for the price of gold. See? One domino just knocks over the next. But here's the real kicker. This whole chain reaction doesn't take months to play out. The market, and especially the gold market, starts pricing in this entire sequence of events almost instantly. It's always trying to look ahead. And that incredible speed is what catches so many everyday traders completely by surprise. Which leads us to the people involved. How do different folks in the market act when this kind of volatility strikes? Well, the difference between the big institutional smart money and your average retail trader is, well, it's night and day. Think about it. When there's a sharp drop, the knee-jerk reaction for many everyday investors is emotional. They see red, they get scared, and they sell the dip, hoping to avoid a bigger crash. But the institutional players, they operate differently. They might trim their positions at first, sure, but then they wait. They watch for a clearer signal on policy, and then they start strategically buying back in, often at much better prices. So those big, scary drops that are followed by a super quick recovery, it's not always chaos. From this viewpoint, it's actually just large players making calculated moves. It's a position adjustment. It's a normal feature of this kind of market, not a sign that something is broken. So how does this all happen overnight? Simple. Gold trades pretty much 24 hours a day. Let's say a big announcement is made at 8 p.m. Eastern Time in the US. Well, the markets in Asia are just getting going, so they react first. A few hours later, Europe wakes up and follows suit. By the time the US stock market opens the next morning, the main event has already swept across the entire planet. And that's exactly why these price moves can feel so sudden and shocking. If you're just waking up and checking your phone in the morning, it looks like some crazy random event just happened. But the truth is, it was a ripple effect that played out across global markets while you were asleep. The move is already in the history books. Okay, so with all that in mind, what's the big takeaway here? How are you supposed to read these signals without getting caught on the wrong side of a trade? Well, the piece from Capital Mind has some pretty clear advice on this. First, let's talk about what not to do. The argument is that chasing a price that's already skyrocketing, panic selling into a sudden crash, or just making emotional trades based on a scary-sounding headline, these are the classic mistakes people make when policy is driving the market. And this really boils the whole thing down to one simple idea. You have to tune out the daily noise. The real signal isn't the news cycle. It's the underlying direction of policy. That's what the market actually cares about. So instead of being glued to the headlines, the suggestion is to focus here. Look at the policy pressure points. Watch how the dollar is behaving. Pay attention to what the Fed is saying and how they're positioned. And watch how the institutional money reacts. These are the indicators that are going to tell you where things are really headed. And that leads us to the final and maybe most important thought to leave you with. If the retail traders, the little guys, are selling in a panic when these sharp dips happen, it really makes you ask the question, who is on the other side of that trade? Who is calmly buying up all that gold while everyone else is running for the exits? That's the question worth thinking about.